Hi, this is Kwesi Nichols coming back to you from realestateinvestorbirddog.com. Hope you enjoyed some of our modules that you've heard thus far. One of the things we're going to talk about right now is owner financing. Lease to owns, owner financing, they're all similar. Today's discussion is about owner financing. And we're going to tell you some of the pros and cons of owner financing and how that can work for you as an investor. It's very important to know this fact. It's a simple fact, and many people don't understand how important it is and how it applies to you and makes money. One of my prized students, his name is Dante, he does a lot of owner financing, he's very good at it, and has been doing it for a long time. So I asked him to come here today to talk to you about owner financing and show you some of the tricks of the trade. We're going to give you a total foundation and get you on your way to making money with owner finance deals. I've asked Dante to tell you some of the things that you need to look for an owner finance deal, some of the ways to approach an owner finance deal, and how to write up your contracts for owner finance deal. And most importantly, some of the things that you need to do to make sure that you stay in good faith with both your seller and your tenants for owner finance deal, and how much money you need to make during an owner finance property deal. So without further ado, Dante, would you like to come in and talk to us about owner financing?
Hi folks, my name is Dante Magic, and I want to start out by thanking Kwesi Nichols for introducing me and allowing me the opportunity to tell you folks about owner financing. I am with realestateinvestorbirddog.com. I am Kwesi's top prize student, well, one of his top prize students. I don't want to say the top because I don't want to put myself on that pedestal. And I'm also with birddogsgetpaid.com. And the first thing we're going to start out with today with owner financing is one of the best ways starting out as a new investor to get your feet wet without really, coming up with any money out of your pocket, any credit, or basically coming out having to apply for a loan. That's why I like owner financing starting out, because when I first got into the business, I didn't have much money, and it was, I was racking my brain basically trying to come up with solutions to buy properties. And the word that kept on coming up for me was owner financing. And the reason why owner financing is good is because basically what you look for are homeowners that are in trouble, or homeowners that are going through foreclosure or divorce, bankruptcy, transferring, or whatever the reason is. What you do is you come in, offer the owner a solution, basically negotiate a good price with terms. And normally what I do is I try to give the owner a good interest rate so they'll be, more likely to want to deal with me. And owner financing is the same thing as subject to lease options, but today we're going to talk about basically subject tos. Subject tos are when you take over a person's home subject to their existing loan. So in other words, you're getting the ownership to the home, but the homeowner still stays responsible for the mortgage. So in most cases, what the homeowner is, you have to build up a trust with the homeowner. You have to come up with a few solutions, because one of the main concerns that a homeowner has with me is, how do I know my payments are going to be made? And me personally, what I like to do is I like to let my attorney or some other third party be the servicer for the owner finance deal. And anybody, you could do an online search for independent or third party services, loan services, to come up with a solution for concerned owner. And another concern is, what if you don't make the payments, or what happens if you don't make the payments, then I get the house back trashed. And what I like to tell the sellers is, I'm in the business of making money, and I'm not in the business of, returning the home back to them and ruining my reputation. So what I like to do is I like to give the homeowner some type of money up front to make them feel comfortable. And I always tell them, hey, there might be a time where I can't actually afford the payments. And in that case, what I do is I make a payment and I give you at least 30 to 60 days notice, because you always know when hard times are coming. So It's best to be upfront with the homeowners up front and let them know what your intentions are and what can happen if things do go wrong, because you don't want to get a name out here as somebody who does owner finance deals and can't hold your end of the bargain. And one good way of really protecting yourself is basically taking the deed, because if you don't, what's going to happen is some sellers in foreclosure, if you don't get the deed from them, they're in foreclosure for a reason, and if they're not paying their mortgage, then there's probably other creditors that they're not paying. So what you need to do is you need to run a title search. There's two different types of title searches that you can run. You can run a basic title search, which is probably like $50, and there's another title search where the attorney signs off on it for title insurance. So basically, the one I would go for is the upper one, the highest title pulling that they could do, because that gives you the security. And also, if there's enough spread in it, what I recommend you doing is getting title insurance. And there's a few little nuances with doing owner financing, because you don't want to trigger you don't want the lender to find out that you actually bought the property, because and one way that the lenders can find out if you bought the property or if the deed has transferred ownership is when the insurance policy changes insurers. So basically what I do is I like to put the property in a trust and make the homeowner additionally insured. That way the homeowner still shows as a party on the insurance. That way it won't raise red flags and all of that, because you don't want a lender calling loans due, even though it's likely not to happen. It can happen. I haven't heard of it happening, but you don't want to be the one that it happens to. So that's one way to protect yourself on the due on sale clause, or the acceleration of a mortgage or deed of trust. And another way that you can really protect yourself is basically, I said get the title insurance to protect the homeowner. What you want to do is you want to get a servicer if they're complaining. And then you also want to make sure that the homeowner signs a CYA letter that basically discloses your position and their position. And basically what this CYA says in this, and CYA means cover your assets. And the reason why you want them to cover your assets, because some homeowners would tell if things go wrong, they'll let an attorney, the state general, know that, hey, the investor never told me about the due on sales clause. So you want them to sign a document stating that they understand about the due on sales clause. And if you happen to buy on owner financing and sell on owner financing, then your best bet is to offer that same CYA to your buyer too, because you always want to cover yourself on the front end and the back end. And that's the best way to keep from, coming into some legal troubles. And, if you just stay tuned with this, we're going to have a lot more to tell you on owner finance and lease options and a whole bunch of the other different techniques out there. And like I said, I'm with realestateinvestorbirddog.com and birddogsgetpaid.com. My name is Dante Mazik, the proud student of Queasy Nichols. And see you next time.